Okay, hello everybody. Today is Friday, February 24th. I'm going to be doing the practice exam. I'm going to go over some of the concepts. I probably won't do all the problems, but I'm definitely going to do the ones that are difficult for most students and the ones that students have been having trouble with. Um, yeah, let's just get into it. So for this one, I got the easier one. I should have gotten the harder one so I can show you how to do it better. But the harder one would have cost per unit for all of these instead of the cost per period for these two, because the fixed manufacturing overhead and the fixed selling administrative expenses is given to us here. If you had just the cost per unit, how you would find out the fixed manufacturing overhead and the fixed selling and administrative expenses would be there'll be an activity level somewhere up here. You just are going to take the fixed manufacturing overhead cost per unit, multiply it by that number of units, and that's your fixed cost for the entire problem. Same for the selling administrative expenses. Once you find your fixed expenses, they do not change because fixed costs stay the same as long as you're within the activity level. Okay, so for financial reporting purposes, what is the total amount of product costs incurred to make 5,000 units? Okay, that's cool. So we're just going to add all these variable costs up, the 560, the 455, and the 250. So I will go over here, see if I can do this. 560, 4.55, and 2.15. Okay. And again, these are all in dollars, and I'll make this a little smaller so it's doesn't take up too much space, but these are my variable costs, variable product. Okay. And since they're all variable, I can just sum them all together. So I can hit equals sum, and then 1, 2, 3, enter. So 1230 times the amount of units, which is 5,000. So 5,000 units. Okay, so total variable product would be the 1230 times the 5,000 units, and then total fixed product would be the 21,000. Okay. So here, and then your answer for the total product cost would just be the sum of these two. So 661,500 plus the 21,000, that'll be 82,500. Okay. Total period cost would just be all of your period costs. So I'll go over them right here. I won't do them, but it'll be your sales commissions, your variable administrative expenses, and your fixed selling administrative expenses at the activity level of the 5,000 units, which it says right here. Okay, so that would be our answer here. Now, contribution margin per unit. So the way we find contribution margin, again, I'm just going to say CM, but it's going to be contribution margin. That's going to be our selling price minus variable expenses. Yeah. So that's a good thing to remember. I'm just going to highlight it, make sure we got that 100%. Okay. Contribution margin, selling price minus variable expenses. So it says over there, our selling price is $24.04. So $24.40. Okay. Make that a thing. All right, and now we're going to subtract all of our variable expenses, and conveniently it has them all right here. So we would add all of these up. I'm just going to take the 1230 that I calculated for my variable product expenses, and I'm going to add in manually 80 cents plus 70 cents, which is $1.05. Okay. And simply to find the contribution margin, that's going to be this selling price minus the variable expense price, which is 1060. So that means that for every unit, after we account for all of our direct costs and our period costs, 1060 goes towards covering our fixed costs. I imagine it like contributing towards our fixed costs. But every unit gives us $10.60 goes towards our fixed expenses. All right, total direct manufacturing cost. Okay, remember from chapter 1, there's two important things in this scenario. Total, or there's three actually. One is total, which means we're dealing with all the units. So the realized activity of 6,000. Direct, which means direct materials, direct labor, and manufacturing costs, which means that it's going to be manufacturing costs mean that it's going to be these four. However, the direct manufacturing cost would just be these two. Okay, so we're going to take our direct materials and our direct labor, and we're going to add them up. So I'll take the $560 of direct materials, add $455 of direct labor, and multiply by the realized number of units, which is 6,000. That means our total product cost, or our total direct product cost, or direct manufacturing cost, would be 60,900. Okay. The indirect manufacturing cost would be our variable manufacturing overhead plus our fixed manufacturing overhead. So indirect manufacturing cost, there's only one of them, which is manufacturing overhead. But just remember that manufacturing overhead is both variable and fixed added together. So we would do $2.5 right here, 2.15, right? Yep, 2.15 times the 60,000 units, which would get us a variable manufacturing overhead of 12,900. And we can add in our fixed expenses of our fixed manufacturing overhead of 21,000. Okay, and then we can just sum the two. Okay, sum 33,900. All right, I'm doing the total period cost. I'm doing all. So I wish I got the harder one so I could show you. There's a few more of these, but it'll just ask you. It'll ask you more questions. So make sure that you're able to identify what the problem wants. So when it says total direct manufacturing cost, make sure you know what that is. Total indirect manufacturing cost, know what that is. Like they'll each word means something. Pay close attention to it. Because one word difference could be the difference between getting it right and getting it wrong. All right, total period cost, $1.5 of that times the 5,000 units, because that was before. That's equals multiplied 7,500 plus the period cost of 6,500. That's going to be yep, just those two, 14,000. Cool. All right. Moving on. All right, this is a good example. So here we have our traditional income statement, we have our contribution format statement, and we have our contribution margin per unit. I'm going to do our contribution format income statement first, just so I can show you. And once we do that, it'll probably be a little easier to understand this and do this one. You're welcome to do it any way you want, but this is how I like to divide it up. Okay. So first, every income statement is going to start with our sales. And we can see up here that our selling price per pair of skis is $420. Actually, we don't even need to know the selling price per, actually we will later, but it gives it right here. So this is the total sales right here. So 1,260,123. Cool. Now we have all of our variable expenses. So the way we're going to find our cost of goods sold here, which is a variable expense, is going to be our, let me go to the whiteboard. It'll be our beginning. beginning plus purchases. I'm doing this with a mouse, so just bear with me. Purchases is equal to cost of goods sold, COGS plus ending. Oh boy, ending. Great. All right, so what I want you to understand is that this turns it into an algebraic expression. So if we have three of these, we can find the fourth. So what we can do is we can realize that if we subtract the ending balance, we can make an expression. So if we do our beginning plus our purchases, close the parentheses, we'll do minus our ending, that will equal our cost of goods sold. Okay, this is really important. It'll be important in later chapters, so make sure you commit this to memory. If you have three of these costs, you can find the fourth just by doing this. Okay, so here's how you're going to do it on the test. Our beginning merchandise inventory is 65,000. Okay. Our merchandise purchases was 295,000. Okay. And if we add the two together, we will get what's called our cost of goods available for sale. Okay. All the cool kids call it COGAFs. It's super nerdy, but now you know. This is our cost of goods available for sale. So this is like if Mr. Beast came in and was like, I want to buy all your items. And you're like, this is how much I can sell you right now. That's how much was available in our stores. Remember, this was the beginning, and then this is how much merchandise we purchased. All right, now to find our cost of goods sold, not the cost of goods available for sale, cost of goods sold, all we have to do is subtract the ending inventory. So we'll mark it ending inventory. Okay, ending inventory, which was 110,000. Okay, make that a dollar amount. All right, and if we subtract it, yep, we will get our cost of goods sold, 250,000. Cool. And cost of goods sold is a variable expense. It's the number one expense that you miss because when you imagine a variable expense, you usually imagine all the other expenses. But cost of goods sold needs to be in the variable category. And you might be saying, okay, cost of goods sold could have some fixed expenses into it, which is true. But the reason why it's in the variable expenses is because you can't differentiate between cost of goods sold fixed and cost of goods sold variable or fixed down here, variable up here, but also more practically because the cost of goods sold is variable in the sense that the more we sell, the more our costs are going to go up. So it's variable in that sense. All right, looks like we have two other costs here. We have our variable expense per pair of skis, and we have a variable administrative expense per pair of skis. So we're paying a lot of money in variable expenses, but I'm just the accountant. I'm not in charge of this business. But great margins on the skis. That's a big margin. So the shareholders must be proud. Okay, we will put administrative expenses and the selling expenses, which is down here. Okay, they're usually sometimes it'll say variable expenses, but for this it'll just be administrative expenses and selling expenses because the fact that they're variable is already implied up here. So we'll just put our variable portion of those. So we'll do 49 and 17. So we'll do $49 per unit and $17 per unit. And this is a pro strat too. So the way we're going to find out how many units we sold is we're going to take the selling price, or actually we're going to take the total sales divided by the selling price. Okay, so our total sales were 1,000,002. All right, and we're going to divide it by the selling price per ski, which is $420. Okay, and we'll make both of these dollars. All right, and if we divide the two, it equals this divided by this, we get, hold on, I'm just making sure that's, 20,600. Yeah, so anytime you get a decimal, it could be the answer, but more than likely you just probably missed a number, which I did here. So it's 20,060. Okay, great. And now that went to 3,000 units. Skis sold. That looks weird to me, but that's how I'm going to spell it. All right, 3,000 skis sold. So now that we know it's 3,000 skis sold, we can reference this. So 3,000 skis, and autofill is useless. L6. All right. This we're gonna label. I'm just labeling this just so you guys can see it. But this is selling. And this is admin. Okay. Now I can just multiply these two. Okay. This one will autofill, but I don't trust that. I'm doing it by myself. So 17 times 3,000. 15,000 or 51,000. Okay, great. So we have $147 or 147,000 of selling. And we have 51,000 of administrative. Cool. And that's our selling expenses. I don't see any other selling expenses, or I don't see any other variable expenses. So we're going to move on. But the last thing we have to do, this is going to be our contribution margin, right? Because it's sales minus all of our variable expenses. And if I do that, that's 1,260, 123 minus 448, 123. That is 812,000, 812,000. All right. Now we can add in our fixed expenses. So total fixed selling expenses, and do admin down here too. Okay, selling was 135,000. Okay, this one fixed administrative was 105,000. Okay, and this is our total fixed. You don't have to put anything right here, but you should put something here. This will be our net operating income. It'll be net operating loss if we lost money, but we're definitely going to make money. So we'll do 812, 123 minus 240, 123. 572, 123. Yep, that's our net operating income. That's how much we made. So we accounted for all of these up here. This is how it's supposed to be. Variable expenses, fixed expenses. Cool. Now, here's the fun part. We can check our work by doing the traditional income statement too. So again, when we're doing our any income statement, sales is always going to go first. If we think back to our 201 days, we're going to do cost of goods sold, right? Sales minus cost of goods sold. That's GAAP. And this one will be a gross margin. I don't like how the book uses gross margin. I prefer the term gross profit, but the two are synonymous. They mean the same thing. You'll see gross profit more on financial statements if you were to look into like SEC filings. Okay, we are going to have the same number of sales because regardless of the income statement, the number of sales does not change. So 1,260,000. Okay, and then our cost of goods sold. I'm going to cheat a little bit. If you want to get some good practice, you should calculate these numbers using these numbers again, or these numbers, these three. I'm not going to do that, but you should. All right, so we'll do 250,000. Our cost of goods sold. Okay, and that will be a gross margin of So I'll do 1260, 123 minus 250, 123. That is 101 or 1,001,000 or 1,010,000. So 1010, 123. Okay, that's our gross margin. Now for our selling and administrative expenses, we only had 2 SG&A expenses. However, this is different from what we had before because we're going to add our variable and our fixed together. So let's do that over here. Where do we have our variable and fixed expenses? This is why it's important to label everything. Here we go. So this is our total variable. Now I'm going to add in our fixed. So for selling, we had a fixed expense of 135,000. Okay. And for administrative expenses, we had 105,000. Okay. We'll make those dollars. Okay. Now we can just add the two together. Don't want to multiply them. Google, thank you. All right. Variable plus fixed will get us our total. And again, variable plus fixed, get us our total. Cool. So the selling was 282,000. Okay. And the admin was 156,000. All right. So then I will do the gross profit or the gross margin. I just did it. Gross margin, yeah, minus the 438,123. That'll be 572,000. Now, moment of truth. Did I get all my costs up here? We can check by making sure the net operating income is the same, which we cross our fingers, said a little prayer, right? But we got it. So it's 572,000 each. And if these numbers don't match, you did something wrong, because even though these are different types of income statements, they still show the same thing. Just that's this differentiating between sales and variable. All right, contribution margin per unit. That is going to be pretty easy. So we're going to take our sales minus all of our variable expenses. I'm just thinking, okay, sales minus all of our variable expenses. So we had a selling price of $420. Okay, and then all of our variable expenses, I'll put them here. So we had $49 of selling. We had $17 of admin. And then we have to do our cost of goods sold divided by the number of units we sold. And that'll get us the cost of goods sold per unit. So we'll do cost of goods sold divided by the 30,000 skis sold, 83.3. And I'll make both of these dollars. Okay, so I'll do 420 selling price minus those three. So we'll do equals 420 minus parentheses sum 1, 2, 3. Boom, boom. 20,000 or 20,000, 270.67. Okay. This one's rounded, but 271. Cool. All right. This one's the one I was talking about. That one's a little harder. So we're going to do it. This is the difference. We're doing overhead rates, but make sure that you understand the difference between a plant-wide predetermined overhead rate and a, I'm trying to find the word, the department-wide overhead rate, but where is it? Department predetermined overhead rate. Yeah. Okay, so looks like they'll both be on machine hours, but to do the plant wide first, here's what we're going to do. We're going to take our total fixed manufacturing overhead, which is 33,700. So go here, 33,700. All right, and we'll multiply by the total variable expense in each department. So we'll do the 250, 2.5, and the 5.0. And these are both dollars per direct labor or per machine hour. And then we'll put the number of machine hours for each department here. So 9,100 or 1,000. 9,000, 1,000. Okay. And hit equals and multiply the two. Multiply. Hit the equals. Multiply the two. Multiplied. So now if we sum everything up, we get our total estimated overhead. Okay, total estimated MOH. And then we're going to divide that by the estimated allocation base. I gotta move that over. Okay. So when we do our predetermined overhead rate, remember it's estimated divided by estimated. It can get tricky if you don't do that. So just make sure that both your numbers are estimated. So we'll do 10,000 allocation base of machine hours. And we will get a cost per machine hour, which will be our overhead applied. So we'll do 61,200 divided by 1,000 machine hours, and we get $6.12 per machine hour. Okay, that's not how you spell anything, but I'm an accountant, not a speller. All right, 6.12 per machine hour. That's how we got it. Now to find the overhead cost applied. So again, read the problem. It's the best advice I can give you. Plant-wide predetermined overhead rate is based on machine hours. Calculate the amount of manufacturing overhead applied to job L. So let's go up to job L. Job L, since we're doing a plant-wide, we're not going to distinguish between the forming and the customizing machine hours. We're just going to sum the two. So we have 7,000 machine hours. Okay. Times the 6.2. So 7,000 times $6.2 per machine hour is 42,840. And that's the amount of overhead we applied to that job L. Cool. Assuming the company uses a plant-wide overhead rate, calculate the total manufacturing cost assigned to job L. Okay, so again, make sure you understand the difference between overhead applied and manufacturing cost. Manufacturing cost will be all of our product costs, which are the direct materials, the direct labor, and the manufacturing overhead applied. So to find the manufacturing cost for job L, we simply have to take the two direct costs for job L, which are the direct materials and the direct labor. So it'll be 20,500, which is direct materials plus direct labor. I'll make that $1. So DM plus DL. Cool. Now, to find the total manufacturing cost assigned, which is what we spent on this job, you add the two together, 63,340. Okay. Now for the selling price, this one's a little tricky. People, it's kind of hard to wrap your brain around it, but once you do, it's a little easier. So we're gonna take our selling price and we're gonna see up here that it's a markup of 20% for the selling prices. So I'm gonna move this over. Okay, manufacturing costs for here and we have a 20% markup. So I'll do 0.2 just to like show you, and I'll express it as a percentage. All right. So the important thing to understand about markups is that it's a way to ensure that we're always making 20% more than what it cost us to make. So that's why accounting and managerial accounting specifically is super important, because when you're a business, not only do you want to like make money and make revenue, but you need to be able to compare that to how much it took for you to achieve that revenue. And if you can't, or if you hired a bad accountant, the business is it's a lot harder to make money. So the markups always need to be greater than the cost or the selling price. So I'll do selling price needs to be greater than manufacturing cost. Okay, always needs to be greater. And the way we're going to do that is I'm going to take the markup of 20% and add 1 to it. Simple. We made it 120%. So now rather than doing the long way, which is the manufacturing cost times the 20% markup plus the original manufacturing cost, it's just one step. So that might help a lot of you. So we'll do 663,340 times the 120%. And that'll get us $76,008. Okay. Last thing I'm going to say about this: make sure that your markup, when expressed as a percent, is a decimal. So if you're going to do this in a calculator, you're going to do 1.2, not 120%, 1.2, because 1.0 is equal to 100%. So 1.2 is 120%. And that is apparent if I do this and then click percent. Okay, $76,008. All right, forming predetermined overhead rate. This one is the plant, or this one is the department wide. So again, let's make sure we read everything. So machine hours, allocation base, both departments. What is the predetermined overhead rate in the forming department? All right, so let's go back to our spreadsheet. We'll say forming, and we'll do variable, and we'll do fixed. Okay. The fixed is easy. We'll go up to the forming department. We'll say, okay, we had $31,500 of fixed. And the variable is going to be the $2.50 times the 9,000, which is going to be up here. Actually, no, it's not. So we'll do equals, we'll do 250 times 9,000, 2.5 times 9,123. Okay, and we'll make sure that's expressed as a percent, or expressed as a dollar amount. All right. Then this is our total estimated MOH. Okay. Which is our total. It's our fixed plus our variable. All right. So we're doing the same thing that we did in the previous one, except we're just doing the department. Okay. So for the forming department, we have our total cost now. And now we need to find our total allocation base, which is just going to be the 9,000 hours, the 9,000 machine hours. So it says they're both based on machine hours still. And we'll divide the two now. So this divided by this, we'll get $6. Nice round number. Looks good to me. $6 per machine hour is our forming predetermined overhead rate. So you can see how there's a little discrepancy between the plant wide and the forming, and that's because the plant wide is the average, right? If you were going to average the department wide rates overall, you would get the plant wide. Sometimes it's better to use the department wide if you're building things that have wildly different costs. But if you're manufacturing all the same thing, it's probably better to use a plant-wide predetermined overhead rate because there's not going to be a lot of discrepancy in the fixed costs for each of the departments. Yeah. Okay, so let's do the customizing predetermined overhead rate. So again, we'll go down here, custom. All right, variable, fixed, total. Okay. Our variable, actually, let's do our fixed first. Our fixed was 2,200. And our variable was $5 times $1,000 or 1,000 machine hours. And we'll express both of those in dollars. Okay. And now we're going to get the total estimated overhead by just adding these two together. And then we can divide it. Since they're both based on machine hours, we can divide it by the amount of machine hours incurred. So 1, boom. And we will get a rate of $7.2. Cool. All right, let's do these two. Manufacturing overhead applied to job L. It's just the manufacturing overhead applied based on the two departments' overhead rates. So again, for job L, we had 6,000 forming or 6,500 forming hours, and we had 500 custom machine hours. All right, so to find the amount applied, we're just going to take the number of hours times the rate in each respective department. 500 times the 7.2 rate in the forming or in the custom. All right, and then if we sum those two together, 42,600. That is the manufacturing overhead applied. So 42600. Yep. All right. Now for selling price. Okay, be careful here. We did the overhead. Now we need to do the actual manufacturing cost. Oh, thank you, Professor Griffin, for telling me the exam's available. Cool. Now we need to do the total cost. So there's two things we need to add to job L. We need to add the 10,100 and the 10,400. All right. So let's add the $25,000 of cost. I have it somewhere. Where did it go? Gotcha. Captured it. All right. Now, since we have our direct labor and our direct materials, we can add our direct materials, direct labor, plus our overhead applied, and that'll get us our total cost to us. Careful, total cost to us. Okay, that's the product. That's the product cost. That's the total cost to us. Now we're going to multiply it by the markup of 20%. So again, I'll just do 1.2 here, just to show you. But it's 100. It's 20% markup. And then we'll multiply the two. Thank you for adding them. I appreciate that. All right, we'll multiply 75,720. Okay. T account's my fave. All right, and it's good. We got a bunch of accounts here, so it won't be as confusing. Okay. Just remember, we're gonna have our debits go on the left and our credits on the right. All right. Usually, don't memorize what goes up with the debit, down with the credit, but I will say, usually things go up with the debit and down with the credit. Don't memorize it. just intuitively understand what you're trying to do with each equation or with each entry. I'll show you, don't worry. All right, the first one, letter A, 75,700 raw materials were purchased for cash. All right, so the first thing I want to recognize is these two things are happening here. We're increasing our raw materials and cash is leaving because we're paying for them. So if we're increasing our raw materials, probably debit it, right? 7,5,200 or 7,5,700. Okay, and this is in dollars too. So everything is in dollars, even if we had a certain amount of raw materials we purchased. It's just how we track the dollar cost assignment. All right. And then we'll credit our cash. Since it says purchased for cash, we're going to do 75700, and that'll be a credit to cash for A. All right. Moving on to B. 72,600 raw materials were used in production. Okay, so even if I didn't know where they were going, I could understand that if raw materials are leaving my account, I'm probably going to credit it because we debited it before when we bought them. Now they're leaving the account, so we're going to do 27600, and then that'll be a credit and for letter B. Now, direct materials go into the work in process. They go directly into the work in process. The rest, indirect costs, go to the manufacturing overhead. The way you can remember that, manufacturing overhead is an indirect cost, so that's where the indirect costs go. Cool. So now let's assign this. So 66,400 raw materials go to the work in process. That's letter C. That's B. Sorry. Okay. And then the remainder goes to indirect. So I'm just going to do it on my calculator, but I'll do 72,600 minus the 66,400. That's 600 or 6,020 or 6,200 into the manufacturing overhead account. And again, I'll label that B. All right. So do you see how our debits and credits matched? We had the 72,000 leave, 66,400 went to the work in process, and the 6,200 went to the manufacturing overhead. But both of these debits match that credit in terms of value. Cool. Total labor wages were incurred and paid. Of this amount, 134,100 for direct labor, and the remainder was for indirect labor. Make sure you bring the 1 over, because a lot of people miss that and they just put the zeros, and then that'll flow down to get everything else wrong. So if it says incurred and paid, probably going to be cash. We don't have an accounts payable, so it's definitely going to be cash. So let's first start out with here. So on our cash account, we're paying our people 150,800. Okay, that is C. All right, and now we got to divide up the cost of where they go. So the 134 was directly to the work in process. So 134,100. Again, that'll be C. All right, and then the rest will be to the indirect labor. So I'll do 150,800 minus 134,100. That's 16,700. C. Cool. Divide them up. Direct, work in process, indirect, manufacturing overhead. Cool. Additional manufacturing overhead costs, incurred and paid. Okay, incurred and paid. That's important. That means we're paying for something, we're not applying it yet. Okay, so, and the manufacturing overhead portion implies that, it's going to go to the manufacturing overhead. So let's pay it first. Let's credit our cash account, the 126,700. That'll be for answer D. All right, and now we're going to do the 126,000. So we credited it up here. We're going to debit it down here because that's where you have to have a debit for a credit. And that's going to be D. Okay, scroll up. Remember, incurred and paid. All right, manufacturing overhead of 120,600 was applied. Ooh, applied. That means something. Using the company's predetermined overhead rate. Okay, quick note: if it doesn't give you the manufacturing overhead applied, the way you're going to find it is using the predetermined overhead rate, which is the dollar amount per hour times the amount of hours, or dollar amount per dollar times the amount of dollars. It gives it to us here. I don't imagine you'd have to do it on the test, but if you did, that's how you would do it. Use the predetermined overhead rate. All right. So when we have cost leaving the overhead, actually, I'm just going to describe what's going on. So here we have the manufacturing overhead leaving the manufacturing overhead account and going to production, okay, which is the work in process account. So let's make it leave the manufacturing overhead account. So 1220600. All right, and that is E. Okay, and since we had a credit to manufacturing overhead, we're going to have a debit to work in process E for the same amount. So 120,600. All right. All the jobs in process at the end of the month were completed. Okay. Process, don't call it progress. I made a funny joke in my previous videos about that. So if you want to check that out, that's probably somewhere on Blackboard. All the jobs in process end of the month were completed. That just means that all of our finished goods or all of our work in process goods were completed. And so when work in process goods are completed, they're put into finished goods. Okay, so we know that we have to zero out our work in process because all of our jobs were completed. So 321100. And that is F. All right, and since they left the work in process, they got to go somewhere. So 321100, and that'll be F. Cool. So they moved from the work in process to the finished goods, and they were completed. Now, all the completed jobs were shipped to customers. Okay, so some people think that this has to do with selling. Does not. Only has to do with cost of goods sold, because on the administrative side, the action of moving them from finished goods to cost of goods sold is the expense. Cost of goods sold is an expense account. So when they get sold, you expense them. If you sometimes you'll have both. In that case, you'll do your cost of goods sold expense, and then you'll do the revenue entry. But for this, it's just that. So all of them were shipped to customers. That's pretty easy. So it's going to be 321100 again. And again, that is G. All right. And since we credited the finished goods, we're going to debit the cost of goods sold because we're going to expense the goods that we sold, because you expense them when they get sold. So I want you to notice that when we initially paid for the goods, they got assigned a cash value. Okay. And those values flowed all the way through from raw materials to work in process, some manufacturing overhead, flowed from work in process to finished goods, which ended up in our cost of goods sold. So we're accounting for costs. So every time we buy something or put dollars into something, we have to account for that cost, because ultimately that's a cost that we have to assign to the product. All right. Any underapplied or overhead applied was closed the cost of goods sold. This is really fun if you know what you're doing. It's literally going to be available to you. So you're going to scroll down to your overhead and you're going to say, I had $29,000 of overhead that I never applied to my work in process. And the reason for that is because there was a discrepancy between what we actually paid and the overhead that we assigned to the product, or the overhead we assigned to the work in process using the overhead rate. The way we do this is we zero this account. But before that, I want to describe why we do this. So manufacturing overhead, while the cost can be assigned to products like you see here, it's kind of an arbitrary assignment to those products. So manufacturing overhead is indirect costs. So you can't really, it's not an obvious assignment of cost, but it still needs to be assigned somehow. So during the year, we'll use our predetermined overhead rate. And then at the end of the year, we're going to do what's called a reconciliation, which means that we're going to adjust our manufacturing overhead into our cost of goods sold to more accurately describe the cost that we incurred in order to make our goods. Okay, so the first things first, you got to understand that I need to zero out the overhead. There can be zero overhead left in the quarter or left at the end of the quarter. So the way I'm going to do that is if I see 29,000 on the left for the debit, I'm going to credit manufacturing overhead on the right. And if I hit enter here, it's going to get zero. Great. That's fun. That's what we want. So that'll be H. Now, we don't even have to memorize debits and credits here because we understand we have to zero this, and we understand that we zeroed it with a credit. And if we credited here, we have to debit here, right? So 29,123. That'll be a credit to cost of goods sold, or a debit to cost of goods sold. Cool. That's it. All right. And then our adjusted cost of goods sold, it gives it to us, it auto sums it. So we're going to do 350,100. Okay. We have a schedule of cost of goods manufactured and a schedule of cost of goods sold. I would advise doing the schedule of cost of goods manufactured first, because you're going to need your cost of goods manufactured to do your cost of goods sold. Okay. Best thing to remember here, cost of goods manufactured has to deal with work in process. Cost of goods sold has to deal with cost of goods sold or finished goods inventory. But for cost of goods manufactured, we know that it's going to be work in process, beginning work in process. And I want to go back to the whiteboard. Beginning plus purchases equals cost of goods sold plus ending. They might go by different names, but they are the same. It's the same idea. So I'll show you that in a bit. It won't go under cost of goods sold for this, but it will go under materials used. So cost of goods sold or used. But that'll make sense in a little bit. So let's do our beginning work in process, which is up here, 17,100. All right, cool. Now we do our direct materials. So we'll do our beginning materials inventory plus our purchases of raw materials. So add purchases of raw materials. All right. And actually, what I would recommend is before you do any numbers on the right, I would just get this down so you can, it'll help you guide you. So if we do our beginning plus our purchases, we'll get our raw materials available for use. That's the same as our, what I said was the co-gaps, but it's just available for use. The available we could have put towards it. Now we're going to subtract our indirect materials included in the manufacturing overhead, because we can't double count our costs, because the indirect materials that we incurred right here go into the manufacturing overhead applied, as I showed you before. So that cost needs to be deducted. If you didn't have any indirect materials, you don't need to deduct the cost, but just understand that you need to deduct the cost if you do. So, well, I'm going to break my rule and do 410. I'm going to put the number in just so we get it. All right. Now, if we did all of this right, actually, I'll put in the numbers now. So raw materials beginning inventory was 25,100. Okay. And the purchases was 72,100. All right. And you'll see we have our total raw materials used in production. Nope. Disregard what I just said for the last minute. Here's what we broke my rules. We're going to subtract actually our ending raw materials inventory here. And then we're going to deduct our ending work in process included in the overhead. Okay, so again, this is co-gaps, right? So we have our co-gaps here. Now to get the raw materials used in production, we're just going to deduct our ending materials inventory from that, just like we did right here. We did our beginning, we added our purchases, that was our cost of goods available. Now we subtract our ending, we get our materials used. So used in this scenario. So, okay, ending raw materials inventory, 21,100. Okay, now we're going to deduct our favorite cost of the indirect materials. So 4010. Great. And now it says direct materials used in production, and that's right because that's the amount of direct materials we used. Okay, for this, we have our direct materials. Our two other product costs we need to incur, or we need to account for. Direct labor, manufacturing overhead. This is manufacturing, this one in this scenario, it's manufacturing overhead applied. Manufacturing overhead applied. I made this mistake, don't make the mistake. Manufacturing overhead applied. And sometimes it won't say manufacturing overhead applied. It'll just say manufacturing overhead. Still manufacturing overhead applied for the work and the cost of goods manufactured. All right. There's no difference between these two boxes other than if you wanted to sum them. So I won't, but I'll put them over here just so there's a discrepancy because this was all of our materials cost. And then these three are our product costs. So I don't want to put them over here just to make it look aesthetically better. All right, our direct labor cost is pretty easy. We just read that number of up here, so 92,100. And the manufacturing overhead cost incurred. Oh, be careful. Manufacturing overhead cost applied. Yes, we're using the applied. No incurred over here, at least not yet. So the 41,100. All right, and McGraw-Hill is so nice to sum all of these. Few people were asking me the difference between added and to account for. So this is how much we added in all of these steps. And then this number plus the beginning work in process inventory is how much we can account for. Now, if we remember our this over here, all this stuff, we have to do one more thing in order to find our cost of goods manufactured. We have to subtract the ending. And the way you can remember that is because in the beginning, you did the beginning work in process inventory, and now you got to subtract the ending. So less ending work in process inventory, which is 10,100. Okay. And that is our answer. Cost of goods manufactured. Very nice. It did the math for us. All right. This is the same thing. The schedule is the same thing, except this is for finished goods. So no more work in process. Hello, finished goods. So the beginning finished goods inventory was 48,100. So we're going to do our beginning plus our cost of goods manufactured, which we had over here, 212,290. Yeah, 212,290. $290. Okay, so again, if we do our beginning plus our added, we get our cost of goods available, right? To find our unadjusted cost of goods sold, we're going to deduct our finished goods inventory, which is here, 56,100. All right, and that's our unadjusted cost of goods sold. That's our cost of goods sold before we reconcile it. Using our overhead. So if you see up here, we incurred $42,110 of overhead, but we only applied 41,100. So what we're going to do here is we're going to find the difference between the two. So we'll do 42,110 minus 41,100. Okay. So it might be instinctual to like, okay, if the number's negative or whatever, I'm going to do X, Y, Z. What I like to do is I figure out if it's over applied or under applied, and then by how much. So we can just see it here. We under applied our overhead because we applied less than we incurred, and we under applied it by that much. And if we under applied it, let me just write this down though first. We under applied it by $1,010. We need to add it back in to our cost of goods sold. So we're going to add under applied overhead. and that'll be our adjusted cost of goods sold. So again, the $1,100 or the $1,010 of cost that we didn't account for when we applied our overhead gets reconciled to our adjusted cost of goods sold at the end of the month. All right, home free. Just got a few multiple choice questions left. If 10,000 units are produced, the total amount of indirect manufacturing cost is closest to. All right, so we know that our manufacturing overhead is not going to change depending on the amount of units we produce. But what about our variable manufacturing overhead, right? So if I take the 155 and I multiply it by the 10,000 units, I get 15,500, and then I can add in our 27,900. So 27,900. All right. Manufacturing cost, MC, manufacturing cost. All right. Making up new acronyms as I go, or new letters. All right. Add the two together, that's our indirect. Okay, so reminder that our indirect is going to be just our manufacturing overhead. Got it. You could just say indirect cost, except that would mean that these, because I don't want to confuse you guys, so I won't even go into it. But technically, these are considered indirect costs because they're not directly associated with the product. However, you know that it's going to be just the manufacturing overhead because the manufacturing cost, when it says manufacturing, that means it's a manufacturing cost. And the only two indirect manufacturing costs are variable and fixed overhead. Cool. All right. Using a predetermined overrate based on fixed manufacturing overhead that was based on an estimated total fixed manufacturing overhead of 21,000 and 10,000 direct labor hours. Company actually incurred 113,000 and 10,900. The predetermined overhead rate is closest to. All right, trick question. The actual has no bearing on this. The actual is not included in our predetermined overhead rate discussions. I'm not going to do the math because I know that 121,000 divided by 10,000, which is both of our estimated, is going to be that. Okay, so again, when it says predetermined overhead rate, estimated divided by estimated. Simple as that. Don't get confused with the more information than you should have. All right. By the following date of last month's operation: cost of goods manufactured, unapplied overhead, finished goods inventory, ending inventory. Any unapplied overhead is closed to cost of goods sold. How much is the unadjusted cost of goods sold on the schedule of cost of goods sold? Okay, so we're asking for the unadjusted cost of goods sold, so we're not even going to deal with overhead or underapplied or overapplied overhead. What we are going to deal with is the what I was showing you before. So we are going to take our beginning finished goods inventory like we did for the schedule. So we'll do the 33,123. All right. And then we will add our cost of goods manufactured of 170,000. And now we're going to get our cost of goods available for sale. Again, remember, cool kids call it that, COGAFs. Solid. Then we'll add the two together. All right. That's how much is available for sale. Now, to get the unadjusted cost of goods sold, we have to subtract one thing, and that one thing is the ending finished goods inventory of 40,000. And that means our unadjusted cost of goods sold 163,000. Always nice to have that number be immediately available to us and apparent. Okay, if I can do this by showing all my work and talking and explaining concepts, I think you guys got this. I'm gonna have office hours for today from 1 to 5. I don't know when this video is gonna drop, but definitely pull up. I start in about 20 minutes. And then I'll have some over the weekend too, and I'll have some on Monday. The weekend ones will be over Zoom, so just look out for an email from me for that. And then on Monday, I'll be back in Glen doing it. Good luck, everybody. It's hard at first, trust me, but once you understand it, you get it. Once you get it, you get it. So study hard. My advice would be just to take this exam as many times as you can. Take the practice exam is what I'm saying, as many times as you can, until you get 100%. Better got 100%. Yeah, you're right. You're right. I got 100%. All right, yeah. So that's just light work. That's how it's done. Remember to like, comment, and subscribe, and I will see you guys in the next video.